Hey, it's Rob. Welcome to Everyday Investor, the hottest investment show in the world. That's right, I said it. We've got a great show coming up for you. Wait for it. Coming up, we're talking to August Biniaz, and he's teaching us how we can make money investing in apartment buildings passively.
When you do a conventional mortgage, put down 30%, borrow 70% from the bank, and buy a 100-unit building in the US, you're cash flowing. You're cash flowing to a point that you can send monthly distributions to your investors soon after closing.
Hey, it's Sarah Larby here. Did you know that if you are selling your home or investment property, one of our preferred agent partners will sell it for you for free? That's right, zero commissions. Head over to our website, everydayinvestor.com, to find out more.
You've always dreamed of having rental income, but buying a rental property? Well, that's a tall order. Capitalize on the space in your home instead. Renovate and rent out that space with ease with LegalSecondSuites.com and the team at Wise Construction Group. With LegalSecondSuites.com, our talented team of BCIN designers, engineers, carpenters, and tradespeople can transform that unused space into a beautiful, legal, and safe rental unit. We're empowering the everyday homeowner to become an extraordinary landlord. Get more out of your home. Visit LegalSecondSuites.com for more information.
Hey, it's Kyle from the Kyle Ford Mortgage team. So, rates are in the news. What do we do? So many people ask on a regular basis, I hear rates are going up, should I lock in? The answer always depends on your personal situation, your current rate, short and long-term goals. But as a whole, variable rates tend to do better than fixed. The number one concern I hear is, I would totally go variable, Kyle, but the thought of that payment going up keeps me up at night. Did you know that there are lending products that exist that get the best variable rate mortgages, however, come with a static mortgage payment? That means as the Bank of Canada makes these changes, your payment will stay stable. If you're interested in learning more about these products and how they can be a part of your portfolio, don't hesitate to reach out to myself and the Kyle Ford Mortgage team.
Hey, it's Rob. Welcome back to Everyday Investor. We're talking to our friend August, who helps people invest in multifamily investments, in other words, apartment buildings. August, thank you so much for being on the show with me.
Absolutely. Honor and pleasure to be here, Rav.
Now, you're out in where? Vancouver?
I'm out in Vancouver, in the West Coast.
Okay, and so you and your team, you guys are investing predominantly where? Is it in the States? Is it in Vancouver? Is it in, Russia? Where are you investing?
Definitely not Russia. You don't want to be investing there right now. Our focus is the U.S. and particularly in the Sunbelt states of the U.S., regions that show consistent growth metrics such as job growth, population growth, income growth, and rent growth. Sunbelt states are also very business-friendly, landlord-friendly. There's no really rent control laws there. People are migrating there from California and New York. So we're really following the numbers and investing in these regions.
And so what basically is I want to get your thoughts on what's happening in the world today, specifically North America, but generally, kind of give me the Coles Notes version of what you and your team does. So you buy apartment buildings, but walk me through, how someone like Rav can make money with you.
Absolutely, yeah. So our company is a CPI Capital is a real estate private equity firm with its mandate to acquire U.S. multifamily institutional assets while partnering with Canadian and U.S. LPs. I know that sounds like a mouthful, but overall speaking, to break it down is we're opportunistic investors. We buy large apartment buildings and build-to-rent single-family rental communities. Obviously, we want to continue repeating this business plan. At some point, we run out of our own equity. That's why we partner with retail investors, passive investors, busy professionals to fund the equity needed for our deals. We find one property, do the due diligence on it, put it under contract, create the marketing material, present the deal to our investors, at which time the investors look at the deal, transfer funds, and we jointly buy the asset, with us being the managing and operating partner of this partnership.
Okay, great. And so right now, here we are, in the fall of 2022. it's crazy, right? Interest rates and the government doing this and doing that. First of all, what do you think of all this? If somebody comes to you and says, hey, August, what's happening in the world, specifically in North America with the government, even the Canadian government, and then what are your thoughts on this asset class when it comes to investing in apartment buildings, given with what's going on?
Absolutely. Globally, we're in a very sensitive times. We have the war taking place in Europe. We have the conflict really there with gas prices and the gas transportation from Russia to Germany. It's going to be a cold winter for our European friends. And also we're in an environment of post-COVID. So central banks have printed trillions of dollars, close to $4 trillion just in the US alone. And that amount of money being dispersed amongst people has created inflation. People have extra money in their bank account. They're going to be sitting at home shopping, buying things online. And what that does is over splurging creates inflation. So, focusing on the US, the Fed has only one lever to pull, and that is increasing interest rates to fight inflation. And you've seen the interest rates over the last few months, being risen to a point that has been the fastest rise since the 80s that they've done, 75 basis points at every juncture. So that right there has definitely slowed down the market. You can see that happening with the housing market. You can see it in the commercial real estate space as well. But just to differentiate with what's happening currently, and particularly with the US, the banking system currently is not sick. The economy is not sick. The job market is very strong. They're actually trying to slow down the job market. It's not the same as 2008 when that was the case. We're in a synthetic recession where this is taking place because of COVID, because of the money printed, and because of the steps that the Fed has to take. But overall, we feel very strongly about the U.S. economy. We feel very strongly about U.S. housing. We've seen our asset class, particularly multifamily, perform so well. Through COVID, even post 2008 has beat the S&P 500 over the last 20 years. So overall, feel very strongly, and also the U.S. dollar. It's a great place to invest. Strongest economy in the world, and it's performing better than any other currency. So overall, feel bullish, but careful.
And what is your thoughts on the rates? In the near future, is it going to continue to increase? Is the government going to, especially here in Canada, are they going to see that, hey, maybe this wasn't the right move? You don't have a crystal ball, but what do you predict?
Yeah, definitely don't have a crystal ball. And even the best economists out there who do this for a living, they can't get this right either. But we know that they cannot continue raising rates. And what happened in the 80s when the rates were up to 20%, I don't think that's going to take place. At some point here, they're going to be adjusting it. Even right now, the estimates is that the Fed is going to be dovish on their next meeting and their next interest rate increase. So they're probably not going to have another 75 basis points. So at some point, that's going to be settled down. Now, they're also looking at the effects. Is the next CPI report going to show that the Fed has cooled it off? Is it going to be showing that it's going to be reduced? And that's going to be an effect of what they're going to be doing. So they're sitting back and watching where the economy is at. Job markets are, again, very strong. You got the baby boomer generation that are going through that retirement phase. They're retiring. They're having a difficult time finding jobs for people who are retiring. And the other generation is really not as hardworking as their parents' generation. So it's going to be difficult to fill those jobs. A lot of employees are having a hard time to keep their jobs. So they're not really laying people off. Now, the Fed is, Jerome Powell has said they're looking to have a million people unemployed. So it will balance out the inflation issues. But overall, it is a sensitive time. Again, very bullish on commercial real estate, particularly the U.S., as long as it's the investment checks off certain boxes that we need. But the debt market is very sensitive, so it's tread carefully.
And why do you? Yourself and other colleagues, people that I know, they're big fans of investing, buying apartment buildings south of the border. Does it just not work, August, here in Canada? Is it harder? Are the margins slimmer? Why the States as opposed to here in Canada?
To be frank, it's not even a fair fight. So I'm a Vancouver builder. I've been in this space for the last 17 years, starting out as a real estate agent, starting my own small general contracting firm, eventually building single family homes and scaling up to multifamily. So the dream was to build a large development company here. And when I was introduced to US real estate, particularly this concept of real estate private equity or syndication, which is focused on multifamily and build to rent, single family rental asset classes, it wasn't a fair fight. And frankly, the reason for that is because of the yields that exist in the US. Cap rates are higher, the yields are higher, the investment culture is a bit different in the US. They won't even touch on some of the deals that we're looking at here. So when you do a conventional mortgage, put down 30%, borrow 70% from the bank, and buy a 100-unit building in the US, you're cash flowing. You're cash flowing to a point that you can send monthly distributions to your investors soon after closing. Even somewhat in this environment as well, it's close to be, you're still cash flowing. Maybe you're not hitting the cash on cash returns that you were hitting in the last few years, but you're still in cash flow positive. Whereas if you did the same calculation for a project here in Canada, particularly Vancouver and Toronto, you'd be in negative cash flow. You couldn't even pay your debt service. Now you could do it in other regions, but you won't have the natural market appreciation in those regions. Sure, you might be in cash flow positive or close enough. So it's frankly not a fair fight. Also another factor is the landlord friendliness of the laws that I explained before. There's no rent control laws in the states that we invest in. So when a rental term is over, we can go in and either increase the rents or not renew the lease. That's not the case, obviously, as you know it, here in Canada, Vancouver and Toronto. Even California, which is looked at as a place that a lot of investors don't invest into, the annual increase in rents is 7 or 8% per year. And, at least is around that inflation mark. Whereas here in Vancouver, what are we at? 1.5%, 2%. So, it's a hard place to be investor. Now, there is a ways to make money. It's just this particular business model doesn't work here in Canada.
Yeah. No. I mean, what I hear you saying is that obviously at the end of the day, it's about numbers. Secondly, and it's not a bad thing in different areas and times, but our government is a very conservative government. It's protected us in many ways, but it's also not allowed some of us to do the things that we may want to do. So, no, that's a good answer. Okay, listen, I want to talk about, a past deal, a current deal, if you have one. Let's take a quick break and we'll come right back. We're talking to my friend August. He's teaching us how we can make money investing in the multifamily space, investing in apartment buildings. Don't go anywhere. We'll be right back.
Hey, it's Sarah Larby here. Did you know that if you are selling your home or investment property, one of our preferred agent partners will sell it for you for free? That's right, 0 commissions. Head over to our website, everydayinvestor.com, to find out more.
The mortgage world has changed. Has your advice? Are you looking for a modern approach to your mortgage planning process? Advice tailored to your unique, ever-changing circumstances? Whether you're upsizing, downsizing, purchasing, or refinancing, the Kyle Ford Mortgage team works with individuals and companies to custom tailor the right mortgage product for you. Working with a wide selection of lenders, we're here to serve our clients and help them achieve their real estate and retirement goals. Contact the Kyle Ford Mortgage team today, Canada's mortgage choice.
Hey guys, it's Ken Beekendam here from LegalSecondSuites.com, and the tip of the week for you guys is the difference between zoning bylaw and building code. Did you know that in order for your suite to be legal, you have to both be compliant with the zoning bylaw and the building code? The zoning bylaw is put out by the municipalities and it governs the use of the land, such as unit size, could be setbacks, could be number of bedrooms, other things like that. And then we have the Ontario Building Code, which governs the actual building itself. Minimum room sizes, natural lighting, minimum ceiling heights, fire separation, sound separations. And in order for your unit to be legal, you have to be compliant with both. And so if you want to learn more about how and what you need to follow in order to be legal, check out legalsecondsuites.com/checklist, and you can download an easy to follow guide for how to legalize your unit. Thanks guys, and enjoy your week.
Hey, it's Rav. A few years ago, I learned how to trade stock options by taking the Theta trading course. My son, my friends, myself, all of us benefited immensely by applying their strategies, and I want you to have that same benefit by taking their course as well. I'm not receiving any monetary benefit whatsoever by telling you this. It's just that, as you know, I believe that knowledge mitigates risk. Visit their site to find out more. Hey, it's Rav. Welcome back to Everyday Investor. I'm talking to our friend August. We're talking about how we can make money investing in apartment buildings. So August, on the show, we always talk about trying to answer 4 questions. So when it comes to this space, I want to ask, what's the return on investment? So if I were to invest, $100,000. Now, first of all, is it just cash? Is it also registered funds? RSPs, RESPs, TFSA, and what is kind of your projected return when you're buying an apartment building for a guy like Rav investing?
Great, no, absolutely. A lot of questions there. I'll try to break it down. So overall speaking, this alternative investment space that we're in, that CPI Capital is in, lots of other groups are also in this space as well, but is alternative investments compared to what's in the market. So REITs and other types of investments. These alternative investments, these syndicated investments are outside of that, and they historically yield much higher returns than REITs or other conventional investments provide, like index funds or other types of investments. So because they're structured differently, you're investing with a general partnership, you're investing with a team. It's very intimate, it's very hands-on, and returns are much higher than conventional investing. Now, as far as what those returns are, with CPI Capital and our last 3 deals we've done, our forecasted returns are approximately 20% per annum. So we're looking to double our investors' money in 5 years. Obviously, those are forward-looking statements, so it comes with a certain caveat. These are projections, but that's what our projections are, and that's what we've had so far to date. Our current deal is higher, but I'll go over what the difference between this current deal and other deals we've done. But really, the way we're able to achieve this is by 3 main ways, and I'll go over these are very important. One is by leverage. So we buy a property for $10 million. Hypothetically speaking, we put down $2 million to buy this $10 million of property. So $2 million of equity, $2 million of investor capital, whatever you want to call it, $2 million of cash. We borrow $8 million from the bank. Now, in 5 years, let's say there's natural market appreciation, and there is some form of renovation we do a value add. We sell the property for $12 million. The property itself has gone up only 20%, but our investors' capital or our cash has gone up 100%. So that's how you create value in real estate. But breaking this down even a bit more, so that's like how you create, there's so much value created because of leverage in real estate. But to break it down a bit more, particularly in the value add space, is in the multifamily space rather, is the value add business model. And the value add business model is really, to understand it, I have to differentiate multifamily and single family. Single family is assessed and is really looked at by the investors and the banks by the comparable approach. Both of us own a similar home on the same street. My house has a good tenant. I get double the amount of rent as your home. I can't ask for double the price of my house. I can't say my house is worth $2 million, your house is worth $1 million just because I have a better tenant and I get paid more in rent, because the comparable approach is used. In multifamily, it's the income approach or the cap rate approach, and I'll go into explaining what a cap rate is, but it is just like buying a business. What is that business's income? And that's how you evaluate what should be the business's, what is the business's value. Multifamily is the same way. What is this building or this community's income compared to the cap rate? And that's how you figure out what the asset's value is.
So what you're saying is in general residential real estate, we're looking at the bricks and mortar. But when it comes to apartment buildings, multifamily, we're looking at the tenant role. We're looking at the income that's being produced. And if the income is higher, if you have two buildings that are the same, bricks and mortar wise, but building A has higher rent roll than building B, then building A is worth more.
As long as building A and B are in the same neighborhood and are looked at as the same cap rate concept, then yes, absolutely, it's worth more because it has a higher income. One more thing to add is, keep in mind, residential real estate, single family, let's leave that on the side here, and let's create an umbrella and put multifamily and other asset classes within the commercial real estate space, which is multifamily, it is office space, retail, industrial, hospitality, and build-to-rent single-family rental are all assessed by the cap rate approach or the income approach, not particularly just multifamily or apartment buildings. But yes, you're right.
Got it. And so what would you say is, to define it, I barely finished high school, so take it easy on me, but what is a cap rate?
Cap rates, I can break it down in a few different ways. And I was watching a podcast with and a couple of experts where we spent an hour explaining what a cap rate is. But just to break it down very simply, cap rate is if you would have bought a property cash, what would your rental income be? Your annual rental income be compared to the asset's value. So if you buy something for $1 million and your net rental income, this is net of all your expenses and it doesn't consider mortgages. This is unlevered returns. So what is that rental income? So if you're making $50,000 a year net, your cap rate on $1 million property is at 5%.
5%.
So,
okay.
Yeah. So then you got going in cap rate, exit cap rate, which is also makes things more complicated, and then you got also the area cap rate. And you can ask a real estate agent, hey, I'm looking to buy here. What is the area cap rate in this area? And the cap rate in areas that are more risky or assets that are more risky are higher than areas where the cap rate is lower. So downtown Manhattan, the cap rates are 1 or 2%. Whereas you can buy places in Arizona where cap rates, or Arizona has been coming down considerably over time, but you can get cap rates for 4 or 5%. So it is a lot of different things about it, but it's a gauge that investors use and stakeholders use to quickly try to calculate what is the yield on a certain property or where is the risk associated with it.
Okay, so to be able to figure out value, I take the income, the operating income, and I divide that by the percentage, in the case that you just said, divide that by 5%, and that will spit me out value. So the higher the operating income divided by the same 5% cap rate, obviously my value is now going to go up. So do the math with me for a second. If you were to go into a unit and you were to increase it by, $100 a month. I know the work that we put into it, maybe it'd be more than that. But if we increase it by $100 a month, I'm adding over a year $1,200 more. So if I take that $1,200, divide it by the 5%, what does that spit me out?
Yeah, let me break it down this way. I'll make it a bit more simpler. So we bought an asset in Houston, Texas. It's 232 units. We're going to go in there and renovate the units. Our total cost for renovation is just over $1 million. That renovated per unit will increase our units' rents by over $200 per unit. So if you calculate $200 per unit times the 232 over the 1 year period, we have increased our NOI considerably. We have actually increased our asset value by $8 million. And this is really the eighth wonder of the world, because we come in, this is nothing to do with natural market appreciation because we buy in areas hoping that the market will go up. So in 5 years, we know somebody will pay us more. It's when we go in and do the value add where we increase these rents because of the renovations we've done, and we bring a new tenant or we offer the same thing to the current tenant to move to a different unit when the unit is available. But that nominal amount, that $200 across the 230 units, increased our asset value by $8 million when the cost for us was around $1 million. So we created $7 million of value by doing renovation and increasing rents. So it's really
but to break it down, what you did, you just said on average $200 a month, $2,400 per unit per year, times by the amount of units, you said 200 and whatever. Then you're dividing it by the cap rate. In this case, the cap rate was what?
The cap rate is 4.5.
So we're going to take that so just again, for everyday investors to understand, what you're saying is on average, you increase the rental value after you did what you did, $200 times by 12 months, 2,400 times by the amount of units, 200 and something. That number divided by the cap rate, 4.5%, that's what increased. That number is the $8 million that you're talking about. Now, we have to count in how much renovations. You said 1 million of renovations. So 1 million created 8 million?
Exactly.
Okay, yes, yeah. And so it's the same thing. When I said $100 times by 12 months, I was just trying to, per unit, how much did we increase it by, and then you could times it by. Because when you say projected returns, 20, 25%, whatever, you know, it can sound high, but we want to break down. And so, yeah, that's the specialty, and that's why you call it value add, because you're adding value to this apartment building. So do you have one, give us an example of one you're doing right now or one that's coming up. What are you doing right now?
Well, the one we're doing now is a bit more complicated and a very interesting project because it's a new asset class, and this asset class is so new and name really hasn't been cemented for it, but is known in the industry as built to rent single family rental, BTR SFR. And if anybody does a simple Google search or jump on YouTube, you put built to rent, you'll see so much information and content coming up. And this is basically us buying communities of single family homes, operating them and managing them like multifamily. So it's the same, it's just like multifamily. We actually is known as horizontal multifamily. Now, the interesting thing about, remember earlier I differentiated between single family and multifamily and how they're assessed and looked at differently? Well, a community of single family homes, it actually behaves like multifamily by the way it's assessed and operated, but it actually caters to a larger demographic. People who want to live in single family homes, they live there. People who live in apartments love to live in a single family home. They get a privacy, nobody living above them, below them. They live in a community of all single family, all rental people that are living there. I believe, and this is something our CEO has said, is that what Airbnb did to the hospitality industry is what build to rent single family rental will do to the rental industry, because it's really the future of where rental is going. This idea of living in apartments might be changing, especially post COVID. But that's really the asset class that we're venturing into. It's a project in Tucson, Arizona that we're buying. We're buying 71 single family homes from a developer. Now, the other interesting thing about this project is there is no value add really involved because we're buying them brand new. The value add here is this, is that we're going into contract with a developer today, locking in our prices. We're doing a forward basis contract, and we're purchasing the homes only when they're built and delivered to us at certificate of occupancy. So that's how we're creating the value. The risk we're taking is lease up risk. We're buying the homes empty, obviously. We're renting them out, bringing the lease up to 95%, and that's when the asset is stabilized, allows us to switch to a conventional.
It's August, very, very interesting, my friend. Listen, your information's there on the screen. You don't mind if people contact you to ask you more questions about this one?
Absolutely, contact me, please.
Yes, no, very, very interesting. A wealth of knowledge, and look forward to having you back sometime. Thank you so much for being on the show with me.
Of course, anytime.
Yes, and thank you guys for watching. Without you, we would not have a show. Make sure that you go to everydayinvestor.com. You can watch this show again, any of our other ones. It's kind of like on demand. Until next week, we'll see you next, same place, same time. Honey, I love you. I'll be home soon. Thanks for watching, everyone.